Hi there, I'm Khalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're diving into Nvidia. Did you know that Nvidia was originally founded to make graphics cards for gaming? But today they're basically powering everything, from AI to self-driving cars. In this video, we're diving into the stock of this semiconductor giant. So grab your virtual GPUs because we're about to crunch some numbers. We will break down Nvidia stock using the 5 key factors to form an opinion on whether it is undervalued, fair valued or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation and a sustainable moat. Before we dive into Nvidia, don't forget to give that like button a little love, and if you're new here, subscribe to my channel so you never miss out on any future content. For the first factor, we look for companies with high returns on capital deployed, preferably a return on invested capital and return on equity ratio that is above 15%, as this gives a strong indication of financial efficiency and future profitability. Nvidia is absolutely dominating, with a return on invested capital of 162.9% and a return on equity ratio of 119.2%. These are insane numbers. Back in 2022, both ratios took a hit as profits dropped due to flat revenues and higher research and development spending on next generation GPUs and AI chips. But since then, Nvidia has bounced back strongly in 2023 and 2024, proving just how efficient and profitable their business really is. On top of that, Nvidia's focus on innovation and research and development is key to staying ahead of the competition and keeping those high returns rolling. So let's break it down. Both research and development spending and capital expenditures have been rising every year, showing their commitment to pushing technology forward. Next to that, we look for companies that are able to grow earnings. Nvidia's revenue grew with a compounded annual growth rate of 64.2% and 91.6% for earnings per share over the past 5 years, reaching $3 for fiscal year ending 2024. So what is driving this growth? Nvidia breaks down its revenues into 4 segments, and we can see straight away that the main driver behind their revenue growth is data center revenue, growing with a compounded annual growth rate of 103.6% over the last 5 years. The data center revenues come mainly from shipments of the Nvidia GPUs, such as Hopper and Blackwell. Nvidia claims in their 2024 annual report that $1 trillion worth of existing data centers needs to be accelerated and $1 trillion more is needed to expand the installed base with AI factories in the next 5 years. I believe Nvidia is well positioned to benefit from the booming data center market, especially with its Blackwell GPU powering future AI platforms. However, there's a significant risk to the expansion of data centers worldwide, as the global market will expand at a baseline compounded annual growth rate of 15% through to 2027. Potentially even 20%, but this rapid expansion is outstripping supply. And some markets have seen electricity development constraints. To address this, some cloud firms like AWS and Google are investing in small modular reactors to provide data centers with nuclear energy. But these won't be available until 2030. Whilst AI is driving data center expansion, if AI demand drops or the economy weakens, it could impact Nvidia's earnings. Based on my previous analysis of Amazon, Meta, Microsoft and Alphabet, they have big plans to invest in data centers in 2025. I expect Nvidia's growth to continue, but at a slower pace, due to rising competition and supply constraints. For the third factor, we look at healthy financials. Nvidia has a total debt of $10 billion and $43.2 billion in cash and short-term investments, which is rock solid as they can easily pay down their debt. Nvidia's debt has also been decreasing since 2022, from $12 billion to $10 billion in 2024. Cash and short-term investments have been increasing from $13.3 billion to $43.2 billion over the same time period. This confirms Nvidia's healthy cash flow generating power. For the fourth factor, we will look at Nvidia's valuation. Nvidia's price to earnings ratio is almost 41.7, which is high compared to the price to earnings ratio for the S&P 500 at 29. However, Nvidia is growing much faster in earnings compared to the market, with Nvidia's earnings per share growing with a compounded annual growth rate of 91.6% over the last 5 years. Now, according to super investor Peter Lynch, if earnings growth is higher than the price to earnings ratio, it's an indicator of undervaluation, and this seems to be the case for Nvidia. If we compare Nvidia's price to earnings ratio 41.7 with some of its competitors, the undervaluation becomes more clear, especially since Nvidia has a much higher compounded annual growth rate in earnings per share of 91.6%. The purple line shows Broadcom, ticker AVGO, which is trading at 156 times earnings, with a compounded annual growth rate of 13.5% for earnings per share. The orange line shows AMD, with a price to earnings ratio of 100.6 and a compounded annual growth rate of 26.5% for earnings per share. Lastly, the green line shows Qualcomm, trading at a PE ratio of 16.8 with a compounded annual growth rate of 20.2% for earnings per share. A strong moat is key for future growth. It helps protect long-term profits and market share from competition. Nvidia's moat is built on its dominance in AI and high-performance computing, with data centers being its largest source of profits. Nvidia's GPUs like the H100 and their latest DGX B200 set the standard for AI workloads, while the CUDA ecosystem locks in developers, ensuring long-term reliance on Nvidia's hardware. Demand from tech giants like Amazon, Microsoft and Google, along with AI firms like OpenAI, has driven the adoption of Nvidia's products. In a recent interview with Cleo Abram, Jensen Huang, the CEO of Nvidia, was very bullish on the fusion between Cosmos and Omniverse, which will make it possible to generate AI-driven real-world simulations, to expand Nvidia's moat beyond just GPUs. The fusion between Omniverse and Cosmos could be applied to optimize supply chains, understand the human body better for medical applications, or weather forecasting. Despite its dominance, Nvidia faces growing risks. Competitors like AMD, Intel and cloud giants developing custom AI chips are challenging its market position. Nvidia also relies heavily on TSMC for manufacturing, making it vulnerable to supply chain disruptions and geopolitical tensions, such as the recent US-China export restrictions on chips. Additionally, efforts to break CUDA's software lock-in could erode Nvidia's control over the AI ecosystem. Nvidia's AI hardware uses a lot of power, which is a challenge for its business. That's why companies like Google and AWS are investing in small modular reactors, which are compact nuclear power sources that provide reliable energy. At the same time, Nvidia has made huge improvements in energy efficiency. Back in 2016, OpenAI bought the DGX-1 for $250,000 from Nvidia. Now in 2024, the DGX B200 costs $500,000, but is 6 times more powerful and 10,000 times more energy efficient, which is a massive leap in just 8 years. Now before we conclude on Nvidia, you may have spotted in the chart shown in my video that these were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. In my view, Nvidia is undervalued based on the 5 key factors. Nvidia has delivered impressive returns on capital, but we might see these slow down a bit as competition heats up. Their earnings per share have been growing at an incredible compounded annual growth rate of 91.6%. But with potential supply constraints and increasing competition, it's likely to normalize soon. Financially, Nvidia is in a strong position with $43.2 billion in cash and short-term investments and $10 billion in debt, giving Nvidia a solid cushion to weather bumps along the way. Nvidia's price to earnings ratio of 41.7 is high compared to around 29 for the S&P 500. But their growth justifies it, especially with those crazy earnings numbers. Nvidia's got a strong moat, but we can't ignore the fact that competition is fierce. If history tells us anything, it's that even the most successful semiconductor companies can lose their dominance over time. The tech world is constantly changing, and while Nvidia's position looks great now, it's tough to predict where they will be after 10 years. Let me know in the comments what you think. Undervalued or too good to be true? Or maybe you want me to dive into another company. Thank you for watching and see you next time.